Most people assume they are doing fine financially. Their salary comes in, bills get paid, and life keeps moving forward. On the surface, everything looks stable with low visible risk. But there is one number most people rarely check. It quietly exists regardless of income, time horizon, or lifestyle. That number is called your net worth. If you calculate it today, the result might surprise you. For many people, it sits close to zero after liabilities are considered. In some cases, it is negative due to debt and drawdown effects. This situation is not simply about effort or discipline. The system itself introduces pressure through rising costs, volatility, and delayed compounding. Over time, progress feels slower than expected. At the margin, we focus on numbers people tend to avoid. We look at how risk, time, and structure actually shape outcomes. So you can understand where you truly stand in the long term? Most people assume net worth follows income. Higher salary feels like forward progress over time. But income alone does not define your long-term financial position. You can earn $200,000 a year and still feel stuck. Expenses expand quietly as income increases over time. Without control, the gap between earning and keeping stays fragile. Net worth is not complicated in theory. It is simply what you own minus what you owe. The clarity comes from looking at both sides honestly. The problem is not the formula itself. It is what people choose to ignore over time. Liabilities tend to stay out of sight but not out of impact. A $400,000 house looks impressive on the surface. A $30,000 car adds to that image. On paper, the asset number appears strong. But the full picture includes the financing behind those assets. Mortgage, car loans, and credit lines reduce what you actually own. The net effect can shift faster than expected. This is where perception and reality begin to separate. What looks like wealth may only be leveraged position. The difference becomes clear during stress or drawdown periods. Net worth reflects what truly belongs to you over the long term. It accounts for risk, leverage, and time horizon together. What remains after obligations is the part that compounds. Let's start with the data. The average net worth in the U.S. is about $748,000. On paper, that sounds like a comfortable long-term position. But this number is misleading. It is heavily pulled upward by extreme outliers with massive assets. Most people sit far below that range, dealing with very different risk and volatility. It is like measuring a room's height. One tall basketball player skews the average upward. Meanwhile, everyone else lives within a completely different baseline. So we shift to a better metric. Median gives a more stable reference point. It reduces distortion and reflects a more realistic time horizon. The median net worth is about $121,000. That means half of people are below that line, and half are above it across different life stages and compounding paths. Suddenly, the number feels different. It feels closer to real life and daily constraints. It reflects the slower pace of long-term financial progress, but even this number has limits. It may not provide enough buffer against major drawdowns or unexpected costs, and it is not as secure as it first appears. Because the real issue is not the number itself. It is how resilient that number is over time. Net worth is not about size, but about surviving volatility. If you're under 35, the median net worth is around $13,900. Yes, that's not a typo. It reflects an early time horizon where compounding hasn't had space to work yet. This is not failure. It simply means you are early in the system. The structure needs time before it starts compounding in your favor. By ages 35 to 44, median net worth rises to about $91,000. Income usually stabilizes during this phase. Compounding starts becoming visible, but still fragile. But expenses rise alongside income. Housing, family, and lifestyle begin to expand, sometimes faster than your actual long-term growth. Between 45 and 54, it reaches around $168,000. The increase continues, but not dramatically. Volatility in life priorities often slows the pace. At this stage, many people start enjoying the results. Spending increases quietly in the background. and compounding begins to lose some momentum. By retirement, median net worth is around $266,000. Then it starts to decline instead of rising, because drawdown becomes part of the plan. In the end, money is meant to be used, not just stored endlessly. The long-term goal was never just accumulation. There's one factor that quietly changes everything over time. It is not your salary, and it is not your investment returns. It is something much more structural in how money accumulates. The gap between homeowners and renters is larger than most people expect. It is not a small difference that compounds slowly. It is a structural divide that widens across time horizons. The median net worth for homeowners sits around $255,000. For renters, it is closer to $6,000. The difference is not about effort alone. That is a difference of nearly $250,000. It is not a rounding error or short-term volatility. It is a long-term outcome shaped by structure. One reason is that a mortgage behaves like forced saving over time. Each payment slowly builds equity, even during market drawdowns. It creates a form of long-term compounding through ownership. Rent, on the other hand, does not accumulate into ownership. It solves a short-term need but does not build long-term assets. Over time, the difference becomes harder to ignore. This does not mean everyone should rush to buy a house. Risk, timing, and personal stability still matter. But the direction of your cash flow shapes your financial trajectory. The same income can lead to very different outcomes over a long-term horizon. Small structural differences create large financial gaps. Direction matters more than it first appears. The problem is not just the number itself. The real issue is how you interpret that number over time. Your perception shapes your financial decisions more than the math does. We live in a time where looking wealthy often matters more than being wealthy. Social signals move faster than actual financial progress. And over time, that distorts your long-term thinking. A new car, expensive trips, and visible upgrades feel like progress. They signal success to others in the short term, but they rarely reflect long-term financial stability. Behind those upgrades, there is often hidden financial pressure. Monthly payments quietly accumulate in the background, and that creates a slow, invisible drawdown on your future. Social media amplifies the illusion of constant success. You mostly see the highlights, not the volatility behind them. This creates a distorted benchmark for what normal looks like. What you do not see is just as important. Debt, stress, and zero savings rarely get posted. These hidden variables define real financial risk. Over time, this creates a false sense of falling behind. You compare your reality to someone else's highlight reel, and that comparison ignores different time horizons. Many people look wealthy from the outside, but far fewer are actually building long-term wealth through compounding. The difference is not visible, but it is everything. Net worth is useful, but it does not tell the full story. It captures a snapshot, not your stability over time. What matters more is how your system behaves under pressure. Cash flow determines how long you can operate without stress. Passive income reduces reliance on a single source. Over a long-term horizon, flexibility often beats size. Imagine two people with very different structures. One holds large assets but faces liquidity risk. The other has smaller assets but consistent income in cash. One profile signals wealth but carries hidden constraints. The other looks modest but has control over time. Volatility affects them very differently. If your income stopped tomorrow, the system gets tested immediately. Your time horizon becomes visible very quickly. This is where risk becomes real, not theoretical. If you can only last a few months, the structure is fragile. Drawdown risk is higher than it appears on paper. The number might look fine, but the system is not resilient. The goal is not just accumulation, but control over your time. Compounding works best when pressure is low. Real wealth increases your options, not your image. Wealth is not about looking secure from the outside. It is about reducing constant financial anxiety. When risk is managed, your life becomes quieter. Building net worth is not complicated. But that does not make it easy. It requires consistency over a long time horizon. High-interest debt works against you every day. It creates a constant negative return in the background, often larger than any investment gain you are chasing. Money can either build or slowly disappear. Assets tend to hold or grow value over time. Depreciating purchases quietly lose ground to inflation. Lifestyle is not the enemy, but unconscious spending often is. Awareness creates control over financial direction. Income increases feel like progress, but expenses tend to rise with it. Redirecting that gap accelerates long-term compounding. Relying on one income source carries risk. Stability improves with diversification. Even small additional streams can reduce volatility. Time is the most overlooked factor. Compounding needs space to work. Short-term thinking interrupts long-term outcomes. Wealth building feels slow at first. Progress is almost invisible in early stages. Then one day the curve quietly changes. These numbers might make you uncomfortable at first, or they might make you feel strangely relieved. Both reactions say something important about your relationship with money and risk. Because now you have something most people avoid: a clear view of where you actually stand today. And clarity changes how you think about time horizon and decisions. Most people never actually check their numbers. They rely on hope instead of understanding volatility and trade-offs. And hope, on its own, has no compounding effect. You don't need an ideal number to begin. You start from where you are, including the constraints and risks you carry. Then you let time and consistency do the quiet work of compounding. If you want to keep seeing real numbers like this, stay with us. We'll keep breaking down risk, time, and money step by step. No hype, just clarity over the long term.